Hello and welcome to another episode of Macro Monday. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
And I'm Will Cunliffe, a Research Analyst here at Onyx Capital Group.
Lots of volatility in the market. We'll be analysing the Israel-Iran conflict. We see that Brent spiked, gold spiked as well. Plenty of charts and risk to discuss.
We'll be looking at US inflation and the potential decisions on interest rates that will be arising from this inflation data.
We'll also be having a look at the soft inflation data that's been coming out of China and what the PBOC may do.
So firstly, if we go to the Israel-Iran conflict, I mean, plenty happening there. We saw the oil price spike on Friday, lots of headlines over the weekend. Just to discuss some of the extremes, JP Morgan said that oil could spike to $120, which would drive US CPI to 5%. So guys, what's been happening over the weekend?
Yeah, so obviously we've seen a ripper in the Brent markets in futures. The story is that Israel and Iran have re-escalated tensions between the two. You've seen missile strikes not only successfully done from Israel on Iran, which, you know, of course, is a major oil producing country, but you've seen the Iron Dome of Israel be penetrated and attacks on Tel Aviv from Iranian forces. So what we're seeing here is a real escalation of affairs, and this is having a pretty significant impact upon Brent, obviously. So we had previously been in a range where, if you look on the chart, we were, post-tariff news and a huge sell-off in futures. We had Brent, ceiling that this roof was like $69 super comfortably, wasn't getting above there. And then all of a sudden, it just absolutely ripped through that. Waking up on Friday morning, you saw prices around $72, $74 per barrel. And then this morning, last night London time on the US Open, on the Brent Futures Open, we saw Brent front month prices going up to $78, almost $79 per barrel. And then this suddenly sold back off to nearer $75 per barrel, $74 per barrel at the time of speaking.
Where was the peak? The peak was on Friday, wasn't it? Was it above $80 briefly?
Potentially at the tick level, but on sort of the minute candle chart, it peaked at like 78.50, 78.60 around.
So actually prices are, I won't say considerably low, but they're down this morning.
Yeah.
Well, they're on parity with where they were on Friday after the US Open. So it's lower than it opened up this morning, but I think a considerable amount of this is that one of the reasons for the spike is because of stop outs. Anyone that was a short player, they had the settle on Friday well above $70 per barrel. Risk managers, all right, cool, we'll clean house a bit. So they have to absolutely open, as soon as the market opens, they've got their buy orders in, prices roof. And then you see a bit of a steady sell-off as, people start to question, is this a fundamental, bullish market, etc.? And one of the reasons why I think you could look at this picture and say, no, we're not outright bullish flat price, is because of the damage to supply chains. Yes, there are going to be damages to supply chains, refineries in Iran being hit, export ports going to be hit. But a lot of the pattern of Iranian exports of crude, of products, have been east and over to China, etc. These patterns aren't going to be overly disrupted going forward. One of the reasons why in the Russia-Ukraine conflict you saw crude prices spiking to like $140 per barrel was because of the serious reliance that Europe had upon Russian oil, Russian gas. So when Russian crude and products suddenly became sanctioned, that had an incredibly disruptive effect on supply chains, so prices absolutely roofed. There has been, over the past decade or so, sanctions upon Iran, damage done to Iranian refineries, etc. Iran themselves in 2019 attacked Saudi oil infrastructure. So there have been all of these actions sort of continuously ongoing with Iranian crude markets. And so to have this impact, yes, it reduces supply, but it's not going to be affecting the supply chain of Iranian products as much as, previous conflicts have.
Yeah, for sure. I mean, I think, we've seen it before when there's a kind of big volatile escalation, quite extreme kinetic action, that the market tends to jump to, oh, they're going to close the Strait of Hormuz. And we saw Iran rumored to come out and say, we're considering about force majeure in the Strait of Hormuz. But really, you have to think about what would be the motivation behind that. Iran need those crude exports to China. China would not be particularly thrilled if Iran were to close the strait. I think one key indicator here is there's currently about 40 million barrels of Iranian crude floating in floating storage off the coast of China. If they start to draw on that storage, that will be indicative of Iran kind of stopping exports to China a little bit. So that'll be one to closely monitor. But I struggle to see any sort of scenario in which this is in Iran's interest to close the Strait of Hormuz. And we saw in the kind of the tanker wars in the 80s as well. Iraq and Iran were both targeting merchant vessels. So Iran sank about 170 ships. Iraq sank 280, I think. But oil was still flowing. And that actually motivated a lot of infrastructure upgrades. So then you saw the Saudis building the East-West pipeline. UAE have, and that carries about 6 million barrels a day of crude. The UAE have their Fujairah pipeline. Iran themselves have a pipeline out to Oman. So, that there are mechanisms for bypassing and reducing risk in the Strait of Hormuz.
I think that history of, high risk midstream flows of these crude products, etc., have meant that infrastructure was invested in, etc., to mitigate the impact of something like this. So of course, what you will still inevitably see, especially if freight are targeted, you're going to see an increase in insurance on freight prices go up, and then the typical flows, say you're an importer of gasoline from Europe versus Asia, or perhaps even the most typical flows. In naphtha, you have typically more demand in Asia than in Europe. So that's a positive east-west diff. That positive diff gets even larger. Similarly, in gas oil, European diesel is typically more demanded than Asian diesel because of supply. So that's a negative diff, and that diff becomes more negative when freight becomes more expensive. So there are going to be serious movers and shakers in this market. And this is not to sort of undermine any of the flat price changes that we've seen in Brent. But I think it's worth noting as well, who are going to be the real winners out of this increase in prices? Well, to my mind, of course, it's OPEC, because they had announced that they were going to be going gung-ho, they're going to be increasing production, they're going to be running increased supply throughout sort of June, July, August, etc. One of the reasons cited for this initially was so that they could undercut US shale producers, targeting like $60 per barrel crude. Suddenly, if crude's like now $15 per barrel higher, all of these nations are going to be absolutely, raking it in. And the question then becomes, are they going to increase supply further? I don't think they're pretty much running at like max capacity anyway, so they can't do that. But I think they're going to be increasing these run rates for longer. So in the long term, you're probably looking at that back end of the curve when this, I don't know when Israel-Iran's going to be resolved. Probably not anytime soon. But if you were looking at, next summer or next December's Brent, you're going to be like, right, there's going to be an increase in supply here. So you would expect to see, these Brent spreads, the front ripping, the back end potentially going down.
And I mean, another key benefactor will be Russia, really, in particular. In the last OPEC meeting, for example, they voted against releasing voluntary cuts. So they are really kind of wanting to keep their crude prices elevated. Again, it's conflict related, right? That's a revenue stream for them.
And I think last week the EU had announced that whether or not the US decided to accept it, they were going to be looking to reassess this Russian price cap on oil, because that was currently at $60 per barrel, which when regular crude is around, Brent or TI or Dubai grade crude is around $60 per barrel. It makes Russian crude viable at $60 per barrel. So one thing that the EU had said was they're going to be potentially reassessing that. Well, if regular crude prices go back up to 75, the price cap probably will be maintained at $60 per barrel.
And Russia have a pretty well-established client base that don't really care about the sanctions or the price cap. I mean, we've seen Urals kind of technically able to clear into Europe for a while. trading below the cap, but we've not necessarily seen that uptake in Europe. I think there's still a lot of like reputational hazard associated with taking Russian oil. So I don't know. It's an interesting one. Higher crude can only be good for Russia.
So we'll come back to oil in a second, but I just want to move on to the gold chart because this shows the wider market reaction to what's happened. And you can see from the chart, gold spiked on Friday. Then this morning it opened higher at 3,451. And over the course of this morning, it sold off from 51 down to 11. So that tells you the market's actually selling gold. So the risk fear is being taken out of the market. So the question is, how do you see events, Iran-Israel events developing over the next week or few weeks? I guess the big risk, well, one is Strait of Hormuz we don't think will get closed. Another one is whether US become involved. And there was a headline briefly yesterday that Donald Trump said it's a possibility.
I think they will try hardest to avoid escalating by the US coming in. I think that would obviously have a bullish response in oil markets, and that kind of goes completely against his whole strategy of cheap gasoline, and he is aware of that. Although Iran did say that if US or UK assets, for example, were to stop retaliatory strikes against Israel, then they would not they would not be opposed to targeting those assets.
But in many ways, hasn't Israel hit a lot of Iran's defences and taken out a lot of their aircraft? So actually, that's one reason why the market's not seeing escalation here, because Iran's been hit so hard in the first strike.
I think a lot of people probably do underestimate the size of Iran's military and their capabilities. We've seen recently with the recent strikes, they're using the new hypersonic missiles as opposed to the traditional ballistic missiles as well. Ballistic missiles, they have that parabolic trajectory. They're relatively easy to intercept if you spot them on radar early enough. The hypersonic missiles fly very close to the ground and they're very maneuverable. So they do have, pretty advanced military capabilities. But I think it's more of a fact that I think the market will know that Trump is reluctant to intervene kinetically.
I'm going to take the opposite point of view here. So I think basically, if you look at this whole situation, the Iron Dome being penetrated, that's a very worrying sign for Israeli defenses. This Iron Dome was purported to be sort of the world's best, world leading. The US have been involved all along. They, whilst they may not openly say, yeah, we're going to war, or they are tacitly supporting the Israeli government. Yeah. Everyone knows this. The question then becomes, is Trump going to go and sort of agree to like an all-out war? It's not about, am I going to be putting my thumb on the scales and supporting Israel? They're already doing that. It's, are the US going to be frontline involved in a war? Trump over the weekend did his 250th anniversary, this military parade, looked, rather reminiscent. Kim Jong-un would have been proud of it, I would have thought. But ultimately, the question then becomes, can the US afford to get involved in this war? I don't think, given where US debt is, etc., that they're in the short run going to be, they're hamstrung. They can't get involved in this. So it's not that they don't want to, and it's not that the market necessarily thinks that, the US, is going to be like playing global world peacekeeper, etc. No, I don't think the US can afford to get fully involved in this war.
Another point, though, Netanyahu doesn't want to back down because for years they've said they don't want Iran to have a nuclear capability. So why stop now? Clearly they want to wipe out that capability. So I don't see them backing down. You did see a brief headline yesterday that the Irani foreign minister said if Israel stopped the bombing, then they would stop as well. But exactly, Netanyahu doesn't want to take his foot off the accelerator. Well, he has these plans.
Yeah, I mean, although we have seen this sort of escalation in the past, which has then resulted in, more theatrical retaliation in that Iran will send some drones over to say that they have retaliated to keep face almost, but it was very much a de-escalatory retaliation. So there's definitely a possibility that is what comes this week.
Or they keep pushing and they go for regime change.
Yeah.
So back to gold here. Why would gold be so supported at these levels? And if it's coming back to all-time highs, do we see a potential war in the Middle East? This potential war being significantly bullish on gold, or is it just this safe haven idea? I mean, I'm not sure that I'm not sure that I fancy buying gold here. I've been quite bullish gold for many months now, but I'm not sure that this is my signal to get long.
I think the other thing that plays out here, it's being bought as a reserve asset. We have some slides a bit later saying it's overtaken the euro as the number 2 central bank's reserve asset. So I think this was going into the end of last week, this was another reason to buy gold. It's come off this morning because the fears being pulled back slightly. But again, the key line here is at 3,435. We're about the 15, 16 level when I came on, but a break above there, you'll see technical traders buying, you'll see CTAs buying.
I mean, fundamentally, it's a pretty bullish thesis in gold. You have dollar weakness, and you have an inflationary, potentially inflationary impulse with higher oil prices. You also have, potentially a sell-off in treasuries.
Where'd you put your money? Central banks buying as well.
And huge amounts of central banks buying. So
so gold, the key level's 3,435. You're about 20 points below that now, but a break back above, I think you'll see more buying. But the sort of fears being taken out of the market for the next few hours at least. The US dollar, that is at 3-year lows. Tudor Jones, the famous hedge fund manager, came out at the end of last week saying you can see that going another 10% lower. Euro dollar is trading at 115. I was looking back, it traded at 2008, it was trading at 160. So people are saying the dollar's had a big move lower, it's time for a rebound. It can go a long way further from here. That's a chart of the dollar index. You can see it's trending down and there's no sort of support at these levels. It just seems a one-way direction.
Floating down.
We had some data out last week. Of course, it's all been overshadowed by the events in the Middle East. US inflation came out weaker than expected, both CPI and PPI. We had lots of fears of tariffs sending inflation higher. That's been fairly eradicated. Headline CPI came out up 0.08, expected at 0.2. So that's a lot lower than expected. Core inflation up 0.13 month on month, was expected up 0.2. PPI up just 0.1 month on month, expected 0.2 and 2.6% year on year. So again, coming out lower than expected. We've had weaker inflation data out of China this morning. You can see the 10-year, this is the chart, here's the 10-year yield in China, the government bond. It's going sideways basically. You can see where the big support is at 1.6. Over the weekend, house prices in China came out weaker than expected. We had a bounce in retail sales, but a lot of that came down to government stimulus measures to help support buying of kitchen appliances, amongst other things, which basically brings forward those purchases now and puts them off in the future. So unemployment did fall. That's one bit of stronger data, from 5.1% to 5%.
Yeah, I mean, it's been interesting in China recently. We're seeing a little bit more of that. Bad news is good news as well. So
explain that. What does that mean? Bad news is good news.
So it's a similar scenario when with the US data kind of Q3, Q4, 2024, in that a bad print would be indicative of the Fed cutting. So equities would
more stimulus.
And it's a similar scenario in China. We had the Caixin Services PMI really quite underperform. And then that day the CSI was up, equities really leapt on the news because markets are expecting more stimulus off the back of that. And especially, the consumer repurchase programs and monetary policy easing from the PBOC, that's going to be pretty bullish for equities. And China just have a huge propensity for the 5% GDP growth. The CCP will throw the kitchen sink at it if they have to get that 5% growth.
Interesting with the inflation data as well. We had inflation out of Europe. German inflation's fallen to 2.1%, which is right on the ECB target. But French CPI is at 0.7 year on year. That's really weak. And we're starting to see China move its exports, obviously not to the US, but their exports actually haven't gone down. Now they're going towards Africa, Asia, and in Europe. So I think there's going to be more deflationary concerns in Europe going forward. I see the ECB cutting more aggressively.
Yeah, and I mean, we had a lot of communication come out of the ECB saying, you know, we're not restrictive anymore. The interest rate is in a good place to support the macroeconomy. But then you saw broader euro area inflation printing at 1.9%, which is below target. So the ECB is going to have to keep cutting for sure.
Yeah, the OIS has about, I think, 25, 26 basis points priced over the next year.
Yeah.
What's interesting with this OIS is in a year's time, you're starting to see the curve going up. So the market's starting to say that you'll start to see hikes coming back in.
Yeah.
That's interesting.
Yeah, I mean, one of the things that potentially gives me a bit of hope on the euro-dollar story is the potential interest rate differentials. And I know we haven't touched on the US interest rate here, but I'm very reticent to forecast that the Fed is going to be continuing to cut. I can see the ECB continuing to cut or adding new cuts in, but that's going to have an impact on the euro-dollar that I think could provide a bit of support to the dollar here.
Interesting. Moving forward, briefly, we have the chart here on China's home price drop worsens in May. And of course, the US retail typically invest in equities. The last decade, or 2 decades even, in China, people have invested in property. And that's why it declines, hurting consumer confidence so much.
Yeah, and I mean, that was the big shock, was the collapse of Evergrande in 2021. And ever since then, consumer confidence in China has really been struggling. And the CCP... that's really been the cause of all the intervention we've seen by the CCP. And there was a lot of talk at the start of the year, in particular, about the housing market in China sort of bottoming out. I mean, Chinese officials came out saying that the housing market has bottomed out. So this is pretty concerning data, really, which could, this is, again, going to be very supportive of more stimulus from the Chinese government.
Interesting.
How important is home price data, particularly in China versus, US and UK? Like, house prices in the UK and the US have been, very important, and people have put their savings into brick and mortar since, the 1940s, etc. Post-war, it's been one of the best asset classes. But without this middle class and consumer class in China, is it as important, would you say, in China as it is in the US and the UK?
I'd probably argue it's more important. I mean, like in the US, for example, you'll have a 401k. In the UK, you might have a stocks and shares ISA. In China, you'd have all of your generational wealth would have been typically in property, whether that's first, second, third homes. And then that negative equity after the collapse of Evergrande just triggered a massive negative wealth effect. So the Chinese households are going to have been burned. So as soon as they start coming into the property market again, that is a big sign that China's well on its way to recovery. As house prices keep declining, it's not a good sign for China.
Yeah, I tend to agree. I think in the US, people bought their main residence and they leveraged aggressively, but they didn't invest in further properties. But in China, you heard these stories of people buying 2, 3, 4, even 5 properties.
Yeah.
So it's seen as a big investment.
Yeah.
Also, with China, last week we had the conclusion or the agreement. The China-US agreed in principle to a trade deal. The market largely ignored that, partly because, as the Commerce Secretary Onyx said, there's no text on the deal. So it was more sort of for show than actual a firm agreement.
Yeah.
Kicking the can down the road, so to speak. Moving on to UK data last week, we had some very weak UK, payroll data. Unemployment rose from 4.5% to 4.6%. And you can see here, UK payrolls have fallen over 250,000 since Rachel Reeves' budget in the third quarter of last year. We also had GDP data, monthly data out of the UK, which was weak last week, but that's fairly volatile, so it's monthly data. Yeah. But clearly, this has got to be concerning for the Bank of England and the UK government. That chart alone is pretty, tells the whole story.
Yeah. I mean, the UK has been interesting because Q1 was really quite surprisingly strong. So this labour market data is really going to be a concern for the Bank of England. I think we've had a pretty split committee at the bank, and there's been clearly a lot of debate about the best course for monetary policy.
There's been three-way splits, haven't there,
Yeah.
at the last meeting?
Yeah, we had double cut, hold, and cut.
Yep.
So I think that this chart will probably make the doves grow in numbers.
Yeah, it's a bit like the US data. In fact, it's trending, it's looking negative, it's concerning, but it's a fairly strong economy, so it's nothing to be particularly concerned about. What's interesting is the terminal rates. The overnight index swap has Bank of England's terminal rates about 3.6%, but ECB's about 1.6%. So there's a big disparity there.
Yeah.
And moving on to US equities, or equities in general, hedge funds have been buying global stocks at record levels. Important to stress here the global, because we know in the US, hedge funds have massively lightened up on their positions. But US stocks remain historically incredibly expensive. You can see a lot of movement here into particularly European stocks with a huge stimulus coming out of Germany in particular. If we move on, you can see just how expensive US stocks are, forward PEs across key geographies. You can see the US here, forward PE of 21.7. That's 34% above its 20-year median. And if we go on to the chart of the S&P 500, originally this morning I put up the chart of the actual cash S&P 500, shut at the moment, and you could see how it broken the key support line on Friday. But I pulled up here instead the E-mini, the futures, because you can see again the bounce we've seen this morning. Again, the market was in a bit of a panic on Friday, but now there's a bit of a relief rally coming into the weekend. So again, what's interesting here, it means today's close in the S&P market and New York market will be crucial, because has this trend line broken, then you'll start to see some selling and stops starting to get triggered. But if we see a relief rally, then the fear is taken away.
Yeah, and it's interesting, of course, that it's been hedge funds buying, and like, yes, European, but also to some extent S&P and US equities as well. And that was the key asset class that retail were buying in, hedge funds were selling. Narratives flipped here. So they want to buy, and so I think this sort of upward trend could tick on. Does depend where we get a close today, etc. In terms of the trade craft. But if you're looking at the next, fortnight, etc., I think this upward trajectory could continue despite the PE ratios.
Will, if you had to buy, sell or hold S&P today, what would you do?
I would probably buy. I'd probably still buy. Timing the market's more important than timing the market.
Yeah, good point.
But,
I think it's expensive, and I wouldn't want to be long. I think there will be better levels. If I was long, then perfect, I would hold. But it's expensive and near the all-time highs. But again, if we break above the all-time highs, then again it's off to the races. More buying comes in.
Yeah.
US corporate insider sales are all-time highs. That's an interesting point there. Even while retail have their longest positions ever. You can see here just how expensive some individual stocks are. Basically, the reported PE ratios and forward PE ratios, these are pretty incredible levels, especially Tesla. 179 times and 111 times. We talked about Tesla. If I fast forward to the actual chart of Tesla, you can see here, it's up 22% now since June the 5th when we had the Trump-Musk feud. Last week, Elon Musk came out on X and apologized, to which Donald Trump said that was very nice. To me, this chart, it's in no man's land. I've put two horizontal lines there, the last swing high and swing low. Really, a break above 367 would get me bullish. A break below 273 would make me bearish. Any thoughts here on Tesla?
Yeah, I mean, whilst I still like the S&P, whilst I like the S&P a bit here, and think it's got, decent room to move up over the next 2 weeks, Tesla I wouldn't touch with a barge pole. Like, there's so much noise going on there. You're at the whim of, two egomaniacs that just will say anything and can say anything. And like, I think it'd be really foolish to kind of get involved in a trade here that is not about the fundamentals whatsoever, doesn't have momentum. So I'm not sure exactly how or why you would make an informed decision on this.
You're right. You can go 8% as we've seen on just a headline, but Twitter headlines, not something for me. Here we can see US CEO confidence continues to fall. These are pretty alarming levels. You can see CEO confidence is below COVID lows. Does Donald Trump's policies exacerbate this?
I mean, tariffs, uncertainty, a supposed trade deal with China with no details coming in. There's so much headline frenzy and mud that's just everywhere. I don't understand how you would sort of have any confidence as a CEO to go and go and expend a lot of capital and do major investments. I think it makes sense that CEO confidence is at all-time lows.
Yeah, this is going to be weak for the economy in that case. Hiring's going to less demand for hiring, less capital expenditure.
Yeah, I mean, we've seen this kind of overly pessimistic soft data before, though, and then we saw consumer confidence really kind of rocket up in the last print, up towards where the hard data's been printing. I think we've noticed since COVID for sure that the soft data, everyone is more pessimistic than their spending would actually suggest. So it'll be interesting to see. I think it's clearly not a good indicator, and forward planning in this sort of economy is very challenging for executives. But you never know. Trump might get the tax cut bill through, and there might be room for the Fed to cut back end of this year, and we could see that this leading indicator doesn't actually realize in soft hard data.
Yeah, I was about to say I'm tending to pick on the negatives here. So what are the positives? But you've picked them up there. Tax bill going through. Yeah. On to bonds. The US 30-year continues to hover. It's around 493. Interesting. Tudor Jones said he expects this to go down to 3.5% with a curve steepening. We'll come to that in a minute. You can see here the key level really is about 518. So we're about 25 basis points away. But again, a break above that. And I'm seeing fund managers who are short bonds. So they think this is going higher. Above 518, then it's going to be pretty much fresh air above. You're going to see a pretty aggressive move. And then you would suddenly see lots of headlines about US debt concerns, dollar weakening.
Yeah, I mean, they would, I remember back in December, they were sort of targeting 5% yields on the 10-year treasury. I think this year there's inevitably going to be more issuance. We're issuing, the treasury is issuing faster and more than last year. It's a supply and demand story at the end of the day. There's only so much treasuries that the market can absorb. And we saw the treasury at themselves coming out and buying 10 billion in sovereign paper. It's unsustainable, and there's only so long that yields can remain at that sort of 4.5% level before it breaks higher.
Yeah. I mean, it's going sideways, but if it does break above this 518 level, I mean, then gold's going to get a big buying surge. That's going to accelerate higher.
Yeah.
But right now, it's trading sideways, but above there, then it's going to be all the headlines. And currencies, we've said the dollar's at a 3-year low. The downtrend continues. Here's a chart of euro dollar, currently at 115. A break above recent highs, 116. It will continue higher. It's one thing, it's trended up this morning. So again, I just see that it's trending, and I don't see anything to break that trend.
Yeah, I mean, it's just more of the same capital flight. We saw this after sort of Liberation Day. Treasuries being sold, dollar being sold, German bonds being bought, and that was supportive of euro dollar. And I think more of that is likely to happen.
You mentioned it last week as well. What you've had here is the ECB cutting more aggressively, but the euro's been stronger. Typically that would mean dollar strength, but
Yeah, I do still see though. I think the ECB are going to have to continue cutting, and that's going to provide a ceiling for this as it's on an uptrend. But if you look at it, that the dollar at some stage, I can't see the Fed being able to cut long term. We can discuss that in a minute, but basically the story there to my mind is if you have tariffs, if you have higher oil prices, all of these things are super inflationary. You can't have all of these things going on at the same time and maintaining low interest rates as Trump seems to want to. I don't think he's going to be backing down on tariffs that much. Like even if he sort of announces 40% on whichever country, In reality, even if it's just a 10% tariff, that's going to be super inflationary. You're going to be seeing not only higher oil prices leading to directly to higher inflation, but if freight, because of conflicts in the Middle East, goes up, then you've got a double whammy on imports from any country that requires, freight passage.
And then add in your tax bill, and it's starting to look a little bit like the COVID era kind of inflation shock, where you have, extremely loose fiscal and then really quite constrained supply. So yeah, I mean, the inflationary story in the US is there's still a big upside risk there.
I really think this is the story this is the setup that we're going for now. Of course, things can happen and things can adapt, but with this shock in the Middle East, we are set up for serious US inflation here.
Yeah.
Interesting. And what the tariffs will also do will hurt Europe.
Yeah.
So again, if you look at the G10 currencies, which would you pick? Well, typically when central banks are cutting rates, you pick yen, but yen's not benefited. We've seen the ECB cutting more aggressively than US, but the dollar's not benefited. So it's almost a case of G10 currency, which is the least worst.
Yeah.
But again, that means typically, gold's the beneficiary, another reason. None of them look particularly attractive.
I mean, you've got to remember that there's also a big German fiscal package coming in, which itself will probably be inflationary.
Yep.
So perhaps that's what the market's looking at in terms of pricing ECB hikes in the future.
But I think the story with the ECB, they've had, this stagflation idea has been really prevalent. So maybe in that sense, they've got a bit of room to move to the upside, and obviously, missing inflation sort of targets, let alone, being at that like upper threshold of their target.
Like the BOJ, let it run a little bit.
Exactly.
Dollar yen going sideways, but again, it's a great chart because you can see the key support at 140. If that breaks, you'll see an aggressive move lower, but I think we need to see weaker data out of the US for that to happen.
Yeah.
Japan's PPI came in actually last week down 0.2% month on month, the first drop in 9 months. So again, that's bad news for Japan. That's the one country that does want inflation. Commodities, here's the chart of gold overtaking euro as the number 2 reserve asset. Again, more support for gold. 3,435, the key resistance level there. And on to platinum, one of the big trades of the last week. You can see platinum and silver, we saw aggressive buying.
It's coming off a bit though.
It's coming off a bit, but we've seen actually a small bounce this morning. But how do you trade that?
I mean, I would look at that and think, the same narrative that we built last week of we as investors, we're looking for alternative asset classes. Gold perhaps wasn't on the uptrend and performing in the same way because of, a very crowded market, etc. So we saw a bit of sideways movement in gold. And so people were looking for other precious metals, so silver and platinum, to invest into. That really provided upward impetus. However, what you've seen over the past week is because of inflation risk, Middle East conflict, you're seeing gold supported. So it's quite a nice trade actually to if you're holding platinum, hold it against gold, or flip vice versa. Like the two can tell the same story. So platinum coming off here, I think, is almost a product of gold rallying. Similarly with silver.
Yeah, I mean, a common thing to look at as well in the precious metal space is like your gold-silver ratios. And that gold-silver ratio had been really quite blown out for a while. So perhaps this move is a little bit corrective on that side, in that gold had really outperformed on the precious metals side. And now we're starting to see platinum and silver catch up.
Yeah, I mean, there's a chance here. The platinum's in a sideways consolidation before the next leg higher. But when you get such aggressive moves, you get aggressive pullback. So the only way to trade that really, if you want to go long, is just slowly scale in.
Yeah.
I wouldn't mind holding all three at the same time. Like, they're all, you mitigate your risk a bit by holding all three, diversifying a bit. And I think holding alternative asset classes overall and precious metals in general is quite a good inflation trade here. So
and diversified portfolio.
Exactly.
And short Tesla.
Short Tesla, big time, yeah.
So what are the fund managers doing? We had Jeffrey Gundlach last week saying he's likening the current market to 1999 and 2007. His company Double Line has cut its allocation to speculative grade credit to the lowest since his firm was founded. Of course, Jeffrey Gundlach, seen as the bond king. And what he's also said actually is US treasuries are no longer risk-free investments. We also had Tudor Jones, again, one of the most famous hedge fund managers of the last 3 to 4 decades. He's likes curve steepeners here. He's, again, fairly bearish the economy. He said he's dovish the Federal Reserve. He says they need negative real rates to get out the debt trap, and they need to run the economy hot to grow the way out of, again, the debt trap. He's looking at curve steepeners. He expects the 2s, 10s to steepen 100 basis points. He expects the 2-year to fall to 2.5% and the 10-year to fall to 3.5%, which are pretty big moves. And he also expects the dollar to fall 10% in a year over the next year. He's long of Bitcoin, he's long of gold, and he's long of stocks on the volatility adjusted portfolio. So what we're seeing is retail traders record long the markets, but we're seeing the biggest, best hedge fund managers in the world with fantastic track records are much more bearish the economy.
Especially US economy.
Yep.
Yeah, and I think reducing exposure to the investment grade corporate debt is particularly concerning. Obviously it's traded as kind of a spread to the treasury. So if treasury yields are going up and that starts to widen, then that's going to be really constrictive for sovereign debt, for corporate debt, for firms' ability to raise capital, which will of course weigh on forward investment. Reducing exposure to the investment grade corporate debt is particularly concerning because often, if you look at credit spreads, for example, they've been really quite tight throughout the hiking cycle. And if they start to blow out whilst treasury yields remain high, then that's going to be really constrictive on funding conditions for corporates. Credit access is key if the US wants to achieve good growth and maintain a strong labour market. So deterioration in credit conditions there could be quite detrimental.
Yeah, an interesting point rolling on from that. Jamie Dimon, head of JP Morgan, he's bearish on the US economy, said there's a chance that real numbers will deteriorate soon. And of course, as head of a bank like that, he'll see the data before any of us.
Yeah.
Bitcoin, what's that doing amongst all this headline news? Well, it's caught in a range. You can see here, sideways range between 112,000 and basically 100,000. Again, I would wait and trade the break either way. Again, I don't have a position in that, but it's sideways for now. Central bank pricing for the next 12 months. Well, the Fed has 3 cuts priced in, but again, I'm seeing fund managers who are talking about the chance that the Fed doesn't cut at all, especially this year. ECB just 26 basis points of cuts. So Toddy, that goes against what you're looking at. There could be a trade there. Bank of England, 67 basis points of cuts. RBA, 88. And Bank of Japan, market still looking at 18 basis points of hikes over the next year. Finally, chart of the week here. Meta looks to be breaking support, but again, this is Friday's close. And again, it looks like equities right now, it looks like they're going to open higher. We've got about another 3 hours till the open. But for Meta, the moving average has just started to roll over. It's attempting to break support, but again, tonight's close will be absolutely crucial. And on to this week's data. I mean, it's largely going to be about Middle East, but the data that's coming out today, we have the New York Fed manufacturing survey. Tuesday, we have the Swiss National Bank's rate decision and US retail sales. Wednesday, we have the US FOMC. Again, nothing expected there. And jobless claims coming out because Thursday is a US equity holiday. We do have on Thursday the Bank of England, and Friday, Bank of Japan rate decision and the Philly Fed manufacturing survey. Just a reminder, of course, we do have daily updates on our LinkedIn page, Onyx Institute. So guys, what are your closing thoughts?
I mean, yeah, I think definitely keeping an eye on headlines and this the conflict in the Middle East is going to be super important. I think the big one, if you were to get some decision on US involvement and any surprise to sort of the upside in that and more interventionist policy from Trump, which I wouldn't expect, to be honest. I expect his tacit support of Israel to continue, but nothing too firm or overt. But if you were to see intervention like that, expect serious volatility. And if you were to see something like that happen on a week with the US equities holiday, things could gap up absolutely to a crazy amount, or
And
gap
get down.
Yeah.
And Will?
Yeah, I mean, I think, it's all going to be focused on the Middle East. I think definitely keeping an eye, as James says, on what comes out of Trump's Truth Social is going to be critical, but also paying attention to what Russia decide to do. They're, as I was talking about earlier, for them, the higher oil price is good, right? They want a higher oil price. So a lot of their communication is, they're probably going to be quite hands-off, but if they start to be a little bit more proactive in their support for Iran, that could be one to watch out for.
So keep our eyes peeled on Twitter, or X as it's now known, for a lot of headline risk.
Yeah.
Excellent. So hopefully you've enjoyed this week's Macro Monday podcast. Good luck in the week ahead, and we'll see you next Monday. Thank you very much.
Thank you.